Today we wanted to discuss why one-legged options are losing most people a lot of money. So let's cut to the chase on this. When you buy or sell a one-legged option, one-legged call or put, people think they're just using it to get leverage on a position, which is very far from the truth. Yes, you technically do get leveraged on that position, but there's a lot more going on, and most people have actually no clue what they're trading. So, and here's why we don't do one-legged options either. So, guys, first of all, there's state of decay, which is time decay. So, if your option, if it's a one-legged option, you're betting on price's direction, whether to go up or down, generally in the short term. Let's say you have a long call. Well, if that stock or ETF, whatever you're long on, does not move substantially in that direction, and or it could even move substantially in that direction, but you don't take profits, you keep holding it, hoping for a little bit of a bigger gain there. While that's happening, that option is bleeding money, guys. The theta decay, the time decay, that automatically makes an option lose value every day. The closer you get to the expiration date of that option, you're going to keep losing more and more value, especially if that call or put is out of the money, which means it's below its strike price. So that is one reason right there why most people just, you hear these terrible day trading stories, people losing all this money. I mean, it's because they're trying to trade one-legged options and they have no clue what they're even doing. Next is implied volatility. So if IV drops after you enter, your option premium shrinks, even if the stock moves as expected, guys. So it's always very important to know if there's earnings coming up or things like that, because a lot of people get absolutely burned post earnings with an IV crush. And also, if they're out of the money, guys, these calls or puts are very cheap for a reason. As we can see right here, let's look at this Tesla chain. Tesla's a stock people love to trade. Volatile, they get big moves out of it. Now, with implied volatility, that's factored in. These options, they're priced correctly. That option is priced correctly. You're not outsmarting the options broker. But let's say Tesla's trading at 331 right now. Let's say 390. 395 contracts. I'm still risking $1,500. Yeah, my max profit second infinite. You can see the mathematical win right here is 13%. And when is this? This is expiring August 8th. So let's say you were trading it this week, and your strike price was something like 360, which people would do because they can't afford a $330 strike price on Tesla. There's ways around that, using ETFs and things like that, but you could see the win rate is absolutely screwed. The option value is only going to go down with theta decay. And the other thing with one-legged options people fail to realize is both directions can lose as well. It's not just getting leverage one side or the other. If you're long or short, either long a call, sell a call, buy or sell put, if a stock moves sideways, you're both getting theta crushed, and your delta's not moving substantially enough to offset that, so you're going to lose money, both of you. So for investors, it's good to look at things like vertical spreads, things like that, where you're any kind of two-legged strategy is generally where seasoned investors have more success. We're not going to get into that too much today. We don't mind one-legged options if it's a hedge against a position, but even then, we still think it's better just to buy a dip if you need to versus especially risking a substantial amount of money. If you want to buy cheap puts, if you think a stock's going to crash, that's what you want to do, go for it. But this is why one-legged options is just a nightmare, especially for newer traders. The chances of you actually being profitable are slim to none from it. And it's just because, like I said, you're not just getting leverage on that position. And I mean, you're already doing a speculative betting on where price is going in the short term. You're betting on the direction of price. And then on top of that, you have things that you might be right, but you might lose money anyway. So you got to understand what these options contracts are, guys. If you have a strong conviction one way, you can use double or triple leverage ETFs, where you're going to have there's volatility decay, but in the short term, you won't really, that won't affect you too much. That's already a lot better than trying to trade one-legged options. But we'll cut the video here. Just wanted to show why a lot of people lose money in one-legged options. Thanks, guys.